Hey everybody, Nate Lind here. I've got another special guest talking to us about the SBA. And in the world of mergers and acquisitions, especially for the online space, the SBA makes a huge piece of that. There's some fantastic opportunities going on right now. The SBA is making the payments for the first 6 months through September of 2020. Steven's here to talk with us about the SBA. Mr. Steven Speer, tell us a little bit about your background. How'd you get to where you are right now? And then I've got a bunch of SBA questions for you.
Great, thank you, and thanks for having me on, Nate. Appreciate it. How did I get? I've been lending for 27 years, and specifically focused in the online business acquisition space for about 5. Initially, I worked for various lending institutions, and I kind of niched myself out. I had a couple opportunities within business acquisition. I had most notably a client come to me saying, listen, I know you finance brick and mortar business acquisition, but I'm really trying to buy an online business. And this was 5 years ago. And I said, okay, all right, I think I could do that. It was all new, even 5 years ago. And so I did my first online business acquisition. I got to know his broker, which happened to be with Website Closers, and then it kind of steamrolled. I got to know Ron and Jason really well, and it kind of steamrolled to other referral partners, and been able to build up a pretty sizable online business acquisition firm. We've done 275 million in the space. We did closed 80 million last year. We're very fortunate to be the go-to lender for just about all online business brokers out there. And quite honestly, at my age, I want to do something I enjoy, and that's really why I'm in the space. I truly enjoy the space. I enjoy coming to work each and every day. So there you have it.
That's awesome. Yeah, and all the guys say you're the go-to, for SBA stuff. Same thing for me too. I'm super passionate about seeing entrepreneurs get to that pinnacle M&A event, whether they be selling or acquiring. And I know the SBA, facilitates a huge piece of that. Steven, tell us a little bit about so let's talk through a couple of different perspectives here. We have folks that are interested in selling and folks that are interested in buying. So on the selling side, how does a seller look at and understand if their business is qualified to be sold and the buyer be able to use the SBA to acquire?
Okay, well, very good question. And we do assist sellers on being able to set up their companies for exit. So, and usually well ahead of time. So the key is to start that process well before the time where you go to market. So usually I work with either directly with them and or their business broker, and being able to review their financials, making sure that the business actually qualifies for financing. I've also, we here have also worked with their CPAs to make sure that their financials are intact. The biggest challenge is commingling. So if we could address commingling of different businesses up front, it'll pay dividends on the back end.
Let's talk about that. And let's also talk about, I know every deal is unique and different, but there must be some guidelines that you can share with us about what makes a business qualified for on the buying side to be able to use the SBA. If you can talk with us a little bit about that, like, tax returns and, that sort of stuff would be helpful.
Well, really the major thing is the cash flow of the business. So the business has to be able to cover the debt service of the loan or the proposed loan. That's the first and foremost. We also look at the type of business it is. Does it have one SKU or does it have many? Is it well diversified? Are the sales channels well diversified as well? So those are some of the things we look at. Is the business domiciled in the U.S.? Does the business submit U.S. tax returns? And it doesn't matter where the business is getting the majority of the revenue, but the business has to be domiciled in the U.S. So that's a few things that we look at. Is the product is it trendy, or is it something that's going to be around? That's another thing we look at. So those are just some of the things we look at. But the main thing is cash flow of the business. Trailing 12 months are great, but we definitely look at historical cash flow. Typically the last 2 years, that's very imperative.
And on the buyer side, what makes a buyer qualified or lendable in the eyes of the SBA? What kind of hoops do they have to jump through?
It's not, I mean, we pre-qualify buyers up front. We do that each and every day. And one of the things we look at is business acumen. Does the buyer have direct experience within e-commerce or indirect? What price point are they trying to acquire business? That really, obviously, the higher up the food chain, the more business acumen they mean. Also, the more direct industry experience they need. So if they're trying to buy, the profile of a buyer is vastly different at 500,000 than it is at 5 million. So if it's 500,000 and the buyer is looking just to get out of corporate America and start his or her own business, that's perfectly acceptable. Whereas at the $5 million mark, they want, the underwriter is going to look for direct e-commerce experience. Secondly, we look at liquidity of a buyer, meaning how much in assets do they have to be able to have for the acquisition. So those are just some of the things we look at. Credit comes up a lot with buyers. They're very hypersensitive about their credit. They tend to bring that up, perhaps through their experience in acquiring a home. We look for 660 middle credit, and it's either a yes or no. Either they have good enough credit or they don't. It doesn't affect their rate in term of the loan, unlike on the residential side. So those are just some of the things we look at. And the main thing is really looking at their profile and be able to be completely candid with them, saying, listen, based on your profile, we think you're a great candidate for business at whatever, $1 million price point, $2 million price point, whatever that price point is. We find a lot of clients, not a lot, a fair amount of clients trying to hit a home run. They have no industry experience. They're trying to buy a $5 million company, and that's just not going to work. So we're able to provide counseling and say, listen, let's back off of that. Let's just try to hit a single here your first time out, and then eventually build that portfolio of businesses.
Because you can get multiple loans. It has to all add up to 5 million or less. But isn't that may be something in the works for changing or going higher, right? Can you talk about how that might work?
So you basically, essentially, you have $5 million of SBA loan allocation. And it could be one loan, it could be 10 loans, doesn't matter, but it's $5 million you have allocated towards you. And it's current balance. So for example, if you got an SBA loan 5 years ago, let's just say for $1 million, and now you owe 250,000 on it, just that 250,000 counts toward your 5 million. So that's really not changing. The only thing that's really changed recently with the outbreak, the pandemic, is the fact that the SBA is going to pick up your first 6 months of loan payments entirely. They're forgiven. They're not deferred. It's purely a forgiven situation. So that's really going to help, I think, spawn a lot of buyers have been sitting on the fence a little bit to acquire a company and go, gosh, my first payment's not going to be until December. This might make sense to acquire a company now.
Heck yeah. No, that's a huge benefit. It's cash in the bank right there. It allows a new buyer to hoard some cash right after their acquisition, get their, kind of ROI, their down payment.
Right. Yeah.
Stephen, tell us what are some of the common reasons that deals fall apart, and how can our buyers and sellers avoid those?
We see a lot of deals a fair amount of deals falling apart actually during due diligence. So it's not really lending related. It's more due diligence related. Perhaps the seller didn't disclose something to a buyer that needed to be disclosed up front. We do see that. On the lending side, the key variable is coming to us before placing an offer on a business. So we're able to vet that business to make sure it qualifies. Deals fall apart typically when you have a buyer who didn't have that business that he's acquiring or she's acquiring vetted up front, and then they come to us for financing and the business doesn't qualify for financing. And it's typically the business not qualifying for financing, not necessarily the buyer. So that's one, I would say, to answer your question in a kind of a lengthy fashion, I would say that's the number one reason.
What are some things for buyers and sellers to expect that the SBA is going to ask for in due diligence? We talked about tax returns. There's some other hot topics that come up?
There are, and first I'd like to address the fact that with SBA loans, couple things. SBA loans are simply loans that are guaranteed by the SBA. They're not funded by the SBA. They're not underwritten by the SBA. Really, it's just the lenders approving the loans and funding the loans, following the SBA guidelines. And in return, they're getting that guarantee. That's one thing I need to touch on. In terms of things that an underwriter, an SBA underwriter would look for, the recent hot topic is post-closing liquidity. So for example, you're buying $1 million company, your injection or down payment is typically 10%, so it's $100,000. And if you look, when we look at personal financial statements, and the buyer shows that he has or she has $125,000, that's not going to work because there's only $25,000 left over in terms of, in case of a rainy day or, having to buy inventory. We really look for at least another 8 to 10% post-closing to make sure that the buyer has enough dry powder to continue to scale that business. In addition to that, we do help with that because we generally incorporate a working capital within the loan to make sure there is enough dry powder, especially on businesses that are very inventory heavy. We make sure we have enough runway for the buyer so post-closing they don't run into any situation such as running out of inventory.
Let's talk about inventory. How is that handled? How's that reported? How's that viewed by the SBA?
Well, I mean, we're able to incorporate that into the loan. So for example, our typical structure is, again, example of $1 million acquisition. Let's just say it's $1 million acquisition and there's another $100,000 of inventory that's going to be sold from seller to buyer. We're able to incorporate that into the loan. Even, like I mentioned, any sort of working capital into a loan as well for perhaps post-closing inventory acquisition. In terms of how the SBA looks at inventory, I mean, it's not worth very much in the eyes of an underwriter because typically it's at an Amazon fulfillment center. It's, generally they discount it 90%. So it's really almost like not having any collateral. Whereas if you were to buy a building, then that, 85% of that building value is counted towards collateral. So that hopefully answers your question there.
Yeah, I can't imagine there's a whole lot of online businesses that have buildings on their balance sheet. And just a bit of a tangent and sidebar. Curious, does that come up very often?
Rarely. We are doing one transaction right now where a client is acquiring a company, and he actually is buying a building to house his inventory. And what's interesting is we're able to structure it where it's one transaction with two separate sellers. One seller is selling the business and the other seller is selling the building. It's very rare though, maybe once a year. I was purely using that as an example to kind of relay back to answering your question regarding collateral. Inventory is not considered collateral. It's virtually worthless in terms of when underwriting a loan.
Got it. Can you talk a little bit about what happens with the transition plan between a seller and a buyer, and what does the SBA allow? How do consultancy agreements work? Shine some light on that subject.
Great. And consulting agreements, I like to see them because it does help with transition between seller and buyer. Generally, they're only allowed up to 12 months, nothing beyond that. So, we like to see them. We want to make sure that when the buyer takes the business over, he or she's not going to hit any hiccups and have, we don't want a situation, in other words, where the seller's handing the keys to the kingdom over to a buyer and saying, good luck. We definitely like to see consulting agreements. So it's allowed, even inventory on consignments allowed. There are certain things that are allowed and certain things that aren't allowed, such as earnouts. That's one thing that the SBA does not allow. And that's why we consult our buyers and review their LOIs or APAs prior to executing them, because sometimes they do happen to put in earnouts and they're not allowed. So
what are some other like war stories? Tell us about a time where a deal got, you know, kind of shaky, you know, on the rails, and you guys were able to pull it out. Love hearing some real life examples. Obviously, confidentiality speaking,
wow.
don't mention any names, but I'm sure you've got a ton of these. Pick a juicy one for us. Tell us a story about it.
Wow, you're putting me on a spot. I needed to know this question well before this this podcast. To really think about one. I think it's more, you know, to answer your question, I think it's more, we've had situations where buyers are, you know, hell bent to go with their neighborhood lender, and despite what the business broker, you know, despite the begging and pleading of the business broker telling them not to, because it's very, even though it just sounds like, okay, I'm borrowing money, there are a lot of nuances within the e-commerce space, within the online space. And most lenders, probably, if I had to guess, over 90% of lenders don't have any clue how to do a loan for online business. So we've had situations where they go with their lender, and at the last minute, their lender's like, oh, we don't want to do a loan. We don't know what we're doing. We don't want to do a loan. And then you know, my senior vice president here and I, Bill, we're in like mad rush to get their loan approved. And we just had that instance this past month in April where that's exactly what happened. They since November, they've been messing around with their lender that had no idea how to do a online business acquisition loan. And we jumped in at the last minute and we're able to get the loan pushed along and on a rush basis.
That's a really good example. Let's pretend for a minute that we're dealing with entrepreneurs that are headstrong, that know a little bit about a lot, maybe everything about everything, and want to go their own way. What should they be asking whatever lender they pick to vet whether that lender knows their ass from a hole in the ground, so they can at least have some heads up that they're gonna be stepping on a mine out in a minefield. What's some gimmies when they talk to a lender to find out if that's gonna happen? I imagine there's some dumb lenders out there that they can maybe avoid by asking a couple of smart questions.
I would ask, you know, to the lender, have you ever done an online business acquisition loan before? And of course, they're going to lie and say yes, and say, what's FBA? Not SBA, FBA. And they'll have absolutely no idea what FBA is. They'll go, what do you, like, you mean SBA? No, FBA. How do you handle, you know, businesses that use Amazon fulfillment? They'll have no idea. They won't even know what it is. They won't even know what a fulfillment center is in most cases. So I would ask that. I mean, that basically, you know, separates the men from the boys right there. So that's my advice.
Yeah, the one question to vet whether your lender's a knucklehead or not, you know, with online stuff. That's a good one, because if they don't know FBA, everyone involved in e-commerce should know what FBA is.
What's 3PL? They'll have no idea.
Yeah.
So those are a couple of things, and those could really cause problems down the road for a lender, especially when the inventory is being held by Amazon. A lot of lenders do not allow that.
Yeah, good one. Yeah. Steve, what else is top of mind for you right now? Anything that you're passionate about, something that's juicy or relevant that you'd like to share with potential buyers or sellers in the online M&A space?
Yeah, so I'll start with buyers. In terms of buyers, you know, even if you have the cash to buy a business, acquire a business, there's really cheap money out there. You could acquire $1 million business with just 10% in. It's $100,000. Most of these businesses are growing at 20% clip. That's a 200% return on your money. Plus, you're not using all your money. You're able to do other things with it, perhaps acquire additional businesses. So a lot of our clients, they do have the wherewithal to pay cash for a business, but choose not to because they want to buy several businesses over time. Perhaps it's a plug and play move where they acquire one business and then they acquire another one next year that's run very similarly and kind of, you know, have a synergistic approach there. So that's one thing. And on the seller side, it's just absolutely vital to be able to shore up your business to have it where it's financeable through the SBA, because it's going to be opening up your buyer pool significantly. It's going to increase your buyer pool astronomically, because obviously, especially in the higher $1 million or higher price range, if you don't have financing available, or if your business isn't financeable, for lack of a better term, you're really limiting your buyer pool. Whereas if your business is SBA pre-qualified or eligible, I mean, just 10% in, a buyer could come in that ordinarily might not have the money to pay cash and acquire your business. And lastly on that, sellers, you're going to get more, you're going to be able to sell your business for more if there's financing available for the acquisition of your business.
Yeah, absolutely. Bigger buyer pool, higher sale price, no earnout. I mean, it's like a dream come true for a seller. You got to get your ducks in a row. Nothing's more frustrating than pulling up to the race and you've got no fuel, or your engine is sitting on the ground. It's like, well, okay, we got to go back to the pits, pit stop and work on it.
And one other thing, and I wanted to clear the air on this because it does come up a lot. Especially with some business brokers, is like, gosh, SBA process takes so long. It's takes 6 months. It really doesn't. If you're working with a competent lender, and I think we are, typically the process takes 45 to 60 days, probably more like 60 days right now, because everybody's working out of their homes because of the situation. So, but it's not like going into a dentist. It's not that bad, despite all the horror stories you hear. And it could really allow you to really scale a business and get a great return on investment by obtaining financing for the acquisition.
Yeah, I know the brokers at Website Closers, we love it. I mean, it's a great opportunity, for all the the positives and the benefits that we mentioned. Steve, I appreciate your time today. For those of you that are watching, stay tuned. We got more great stuff coming. Thank you again, Steve.
Thanks for having me, Nate.